What is a SPAC? A SPAC is also known as a Special Purpose Acquisition Company. It is a company that has no assets, no liabilities, no operations, only cash. This is also known as a blank check company. The only reason for the existence of a SPAC is to raise cash from investors and to acquire a company that is not publicly noted. This company could be a specific niche company or a company that holds a certain technology that could be worth investing in. There are all kinds of available options to acquire. A SPAC is quite an interesting investment vehicle, and they have been around for a lot of time, but have become more popular in recent time. The purpose of a SPAC is to find a company that is not publicly noted and buy the company so that the company that is being acquired gets to be publicly noted but without the long and costly IPO process. This is beneficial for both the investors in the SPAC and the investors of the acquired company. It is quite an efficient investing method if done the right way with trustworthy managers. Also, if the SPAC doesn't manage to find anything to acquire, then the money is returned to investors after a limited amount of time, usually 2 years. Just be careful that the money that will return to investors if the SPAC fails to buy another company will only cover the original worth of the SPAC shares. Different SPACs have different investing strategies, with different target companies to acquire. There are some good things with this investing method, but there are also cons. In this video, we will go through the pros and cons and how you should think about investing in a SPAC. There are certain factors you as an investor need to be careful of. Welcome to Nordic Investing. I'm Zain Elias, and today we're covering SPACs. As mentioned before, there are both pros and cons with investing in a SPAC. If looking at the pros, there is a question of efficiency when it comes to the acquired company. The SPAC is usually run by venture capitalists or investors that have experience in this field and can guide the acquired company through an easy IPO. If the target company would pursue an IPO by itself, the length and the cost of this process would far exceed the process of being bought by a SPAC. Also, private investors rely on the diligence of the managers of the SPAC to find a good deal that is outside the market, and if the managers of the SPAC do find a very good acquisition, then the private investors can be a part of the IPO and earn good return by keeping their shares and becoming owners of the newly acquired company. Also, the company that is being acquired will now have the cash available from the SPAC to grow the business and reward investors further down the line. So there are benefits for both parties when it comes to the process of a SPAC buying a company and through that process making it publicly available for the stock market. We should also note that if a SPAC cannot find an attractive company to buy, then the SPAC will be liquidated and the money will return to the original investor depending on the amount of shares the investors owned. Usually, when a SPAC is formed, the share price initially sells at $10 per share, so you can never lose more than that amount of money. However, if you buy shares at a higher price, since these shares are publicly traded, the lowest they can go to is $10 per share, so there is some form of safety net when it comes to investing in a SPAC. If you, on the other hand, pay too high of a price, just like investing in any security, you might risk losing a lot of money. So be careful about the amount of money you put in, and at what price. It is always wise to have some form of margin of safety. Let's talk about the cons. One of the bigger cons when it comes to investing in a SPAC is that they tend to be quite volatile, and the price per share often reacts to news or information surrounding the SPAC, which opens way for quick price movements. There is also the aspect of opportunity cost when you invest your money in a SPAC for longer time periods. If the SPAC don't find any investment to make or don't find any company to buy, then your money has been locked up for 2 years. This is a form of opportunity cost because you could have invested your money elsewhere and earned a return during these 2 years. Since share prices are quite volatile, SPACs tend to attract a lot of speculation. It would also be wise to read up on what the type of industry the SPACs want to invest in, and if possible, you should read up on some financial data for the acquired company if such is available. As mentioned before, you need to also look up the track record of the managers of the SPAC. The track record is probably one of the most important aspects of investing in a SPAC. You should spend time to read the prospectus of the SPAC to get an idea of the strategy and the direction that the SPAC is heading. So to summarize, it is always wise to know what you're going to buy and try to avoid speculation. Investing in a SPAC should be approached like investing in anything else. You should take some time to read about the strategy of the SPAC, and you should also, if possible, not pay too high of a price on rumors, especially when there hasn't been any announcements yet. Alright guys, thank you for watching this far. This is Nordic Investing, and if you have enjoyed the video, please consider liking and subscribing. And remember to always do proper research before investing your hard-earned money. See you in the next video, and thanks.